You know, usually when we talk about a medical diagnosis, there's like this underlying expectation of precision. It almost feels like engineering.
Right, yeah. Like it's a math problem.
Exactly. You break your arm, you get an x-ray, and the doctor just points at that jagged white line on the illuminated film and says, there it is. That's the problem.
The visual evidence is just right there. It's totally binary. Broken or not broken.
And it's comforting. I mean, we like things to be visible. We like them cleanly categorized so we can just, fix them.
Yeah, human nature.
But then you step out of the hospital and into the world of evaluating public businesses for perpetual ownership, and suddenly that beautiful, precise X-ray machine it's completely shattered.
Oh, completely. It's the absolute definition of diagnostic muddy waters.
Right. We are looking at a landscape of corporate quality that is honestly incredibly murky.
Because if you read enough 10Ks or listen to enough earnings calls, you quickly realize that every single management team on Earth claims they have an impenetrable competitive moat.
Every single one.
Every quarterly call sounds like a victory lap, even when the underlying business is, actively deteriorating. They dress up terrible quarters with adjusted EBITDA metrics that exclude all the actual costs of running the business.
Just trying to convince you the sky isn't falling.
Exactly. Which is exactly why today's deep dive is so specific and why we are setting such a high bar.
Right. We have a highly targeted mission for you, the listener, today. You are a public market investor, but you're not a day trader. You aren't looking to catch a quick 20% pop on a momentum swing.
No, you are seeking to identify the absolute highest quality businesses in the world for perpetual ownership.
You want a stock you can buy, put the physical certificate in a steel vault, lock the heavy door, hand the key to your grandchildren, and just sleep soundly for the next 50 years.
A true forever hold.
And today we are putting Danaher Corporation under the microscope to determine if it actually merits that incredibly rare kind of long-term investment thesis.
But to do that properly, to really analyze a business for perpetual ownership, we have to establish an ironclad ground rule right at the top of this conversation.
Okay, lay it out.
We are going to completely, unapologetically ignore valuation.
Wait, really? So we are not looking at the stock chart at all?
Not even a little bit.
Yeah.
The market price of Danaher's stock today, the multiple it traded at yesterday, or what the market might price it at a year from now, is entirely irrelevant to this specific analysis.
That's a huge shift from how most people invest.
Price is simply what you pay on a given Tuesday. Quality is what you actually get. Our job today is exclusively to analyze the absolute, fundamental, mechanical quality of the underlying business.
We are trying to answer one overarching question, right? Like, is this a compounding machine, or is it a mirage propped up by financial engineering?
Exactly. And to answer that, we didn't just read the latest press release. We brought a massive stack of receipts.
Oh, we really did. We are synthesizing a full decade of Danaher's financial and operational history. We've pulled 10Ks, annual reports, deeply technical investor day presentations, quarterly earnings calls, and detailed proxy statements.
Spanning all the way from 2016 right through to 2026.
Yeah. We are not looking at a snapshot. We are projecting an entire motion picture of how this entity operates over time through multiple economic cycles.
And to make sense of a decade of dense financial data, we need a rigorous, really unforgiving framework. If a business is going to justify that vault, if it's going to justify perpetual ownership, it has to excel in 4 distinct pillars.
4 pillars. Okay, what are they?
First, unit economics. At the most atomic level, how efficiently does this company turn $1 of capital into $1 of spendable cash profit?
Makes sense.
Second, the competitive moat. How do they physically and economically prevent rivals from stealing their lunch and eroding those margins over time?
Right, because high margins attract competition.
Exactly. Third, management quality. Are the people pulling the levers financially and philosophically aligned with you over a 10 to 20-year horizon?
That's crucial.
And fourth, durable industry tailwinds. Are they swimming with a massive macroeconomic current, or are they constantly fighting against it?
The journey we are about to take you on today is wild. We are going to look at how a collection of seemingly mid-tier, mid-single-digit return acquisitions was mechanically, almost ruthlessly engineered into a massive $24+ billion high-margin compounding machine.
But we should probably give a spoiler alert right now.
Yeah, good point.
Yeah.
We are not going to just take management's glossy, highly rehearsed narrative at face value.
Because if you want to hold a business forever, looking at how they perform in a bull market is completely useless. You have to look at what happens when the floor falls out.
You have to stress test the machine.
Exactly.
And for Danaher, the floor actually fell out in a very real, very public way during a brutal margin compression event in 2023.
Which we're absolutely going to dissect later to see if the perpetual hold thesis actually survived the impact.
But to understand the crash, we first have to understand the engine. So let's open the hood and deconstruct Danaher's unit economics. What are we looking at here?
Well, if you're looking for a business to own forever, the foundational metric you have to start with is the gross margin. I mean, gross margin is the oxygen of any business.
Because it dictates how much breathing room you have.
Right?
To invest, to make mistakes, to grow.
Precisely. And Danaher's gross margins consistently hover around a staggering 57 to 58%.
Wow.
And during the massive global demand surge in 2021, we even saw that number spike up to 62% in the first quarter.
Okay, I need to pause on that number to ensure the context lands for you guys listening, because a 62% gross margin is usually reserved for software companies.
Yeah, SaaS margins.
Right. Software companies build a product once, and the cost of replicating it and distributing it to the next customer is essentially zero. But Danaher actually manufactures physical things.
Real physical heavy machinery.
They have factories, supply chains, raw materials. They're building complex diagnostic machines, multi-ton mass spectrometers, and physical water quality testing equipment.
It's incredible.
To pull 60% gross margins out of heavy physical manufacturing is it's bordering on alchemy.
That physical reality makes the margin profile incredibly rare. And that high gross margin flows down the income statement beautifully, resulting in an adjusted EBITDA margin that operates reliably in the mid-20% range.
Mid-20s.
Yeah, if you look at the 3-year average from the data spanning 2020 to 2022, they were sitting right at 23 to 24% EBITDA margins.
That's incredibly healthy.
It is. But focusing purely on the accounting profit like the EBITDA or the net income actually misses the true superpower of this business. The true cornerstone of their financial profile is their massive working capital efficiency.
Okay. We're talking about cash flow now.
The lifeblood. Their free cash flow conversion rate consistently exceeds 100% of net income.
Let's translate that mechanic for anyone listening who might not spend their weekends staring at cash flow statements.
Please do.
When a company reports $1 of accounting profit, what they call net income, on the income statement, they don't always actually put a physical, spendable dollar bill in the corporate bank account.
No, a lot of times it's just paper profit.
Right. Sometimes that cash is tied up.
Right.
They had to buy a bunch of raw materials that are sitting in a warehouse as inventory, or they delivered a machine to a hospital, but they are still waiting 90 days for the hospital to actually pay the invoice. Those things tie up cash.
Exactly.
But you're saying Danaher consistently turns every single dollar of stated accounting profit into more than $1 of actual liquid spendable cash.
The historical data on this is absolutely clear. In 2018, their free cash flow conversion was 123%.
So for every dollar of net income, they generated $1.23 in free cash.
Yes. And in the third quarter of 2020, it hit an astonishing 174%.
That is absurd.
Even during the severe operational downturn we mentioned. In the third quarter of 2023, when margins were compressing, the free cash flow conversion was still over 120%.
So they are a cash-generating leviathan.
They run their supply chain and their receivables so tightly, the capital almost never gets trapped inside the business. And the mechanism driving this efficiency isn't macroeconomic luck. It isn't an accident.
No.
It's a highly institutionalized, almost militant, internal operating philosophy called the Danaher Business System, or DBS.
Oh, DBS. When you read through these 10Ks, and particularly the Investor Day transcripts, management talks about DBS with an almost religious fervor.
They really do.
It is the defining characteristic of their corporate culture. They call it their ultimate competitive advantage, their growth, lean, and leadership toolkit.
DBS actually originated on the manufacturing floor decades ago, and it was deeply inspired by the Toyota production system. You know, the lean manufacturing principles that totally revolutionized the auto industry.
Right, the whole continuous improvement thing.
Kaizen, exactly. But over the years, and you see this explicitly outlined in their 2023 annual report, DBS has evolved far beyond just making factory floors sweep faster.
How so?
It has evolved from a set of manufacturing tools into an enterprise-wide philosophy that drives every single aspect of the business. It drives how they approach R&D innovation, how they structure their sales compensation, and crucially, how they allocate capital.
And at its core, DBS physically and systematically removes waste from underperforming processes.
That is the whole ballgame.
Okay, but removing waste is a great theoretical concept, right? How does this actually play out in the unit economics? Like, if I am walking through a recently acquired Danaher facility, what is the literal mechanical reality of this Danaher playbook?
Okay, the blueprint is highly structured and devastatingly effective. When Danaher acquires an asset, they don't just leave it alone. They deploy dedicated DBS teams immediately.
Like a SWAT team.
Pretty much. Step one is attacking the cost of goods sold, the COGS. They analyze the factory floor. They identify bottlenecks where inventory is piling up. They renegotiate sourcing contracts by plugging the new company into Danaher's massive global supply chain.
So they buy materials cheaper.
Yes. And they redesign the physical workflow so that a product moves from raw material to finished good in less time with less labor. That immediately improves the gross margin.
So they expand the gross margin first. Got it.
Then comes step two, which is often brutal but necessary. They rigorously lean out non-customer-facing general and administrative expenses, the
That's back to
G&A.
toughest stuff.
They look for duplicated back-office functions, layers of middle management that are slowing down decision-making, and software systems that just don't talk to each other. They rip out the inefficiencies.
So they're aggressively cutting the fat from the organization.
But step three is where the actual magic happens, and this is what separates Danaher from a standard corporate turnaround.
Okay, what do they do?
Well, a traditional private equity firm might take all those savings from COGS and G&A and use them to pay down the massive debt they used to buy the company.
Right.
Or they might just let it flow to the bottom line to juice short-term earnings to look good for a quick sale. Danaher explicitly does not do that.
What do they do with the cash?
They take the physical cash, freed up from making the factory better and cutting the back office bloat, and they aggressively reinvest it into research and development and sales and marketing.
Oh, wow. I actually saw that exact dynamic highlighted in the 2018 Investor Day transcript. Management was explicitly pointing out that they had systematically increased R&D investment by 10% every single year for 3 consecutive years.
Yep.
And that massive compounding increase in R&D wasn't funded by taking on debt. It was entirely funded by the internal savings generated through deploying DBS.
The mechanics of this create a really powerful operating leverage loop. Just think about the physics of the business model.
Walk me through it.
You lower your fixed operational costs. You take that money and increase the technological value of your product through higher R&D. Because your product is now better, more innovative, and faster, you have pricing power.
You can charge more for it.
Exactly. Or you win more market share from competitors. That higher volume of sales now flows through a factory that you already leaned out and made hyper-efficient in step one.
Which means that extra volume generates even more cash.
Which you then pump back into even more R&D. It's not a theory, it's a mechanical reality.
Do we have data to back that up?
Oh, absolutely. We saw this perfectly illustrated in the third quarter of 2018. Their life sciences segment delivered its 9th consecutive quarter of more than 100 basis points of core margin improvement.
9 straight quarters of expanding their margins by over a full percentage point year over year. That's incredible.
It is.
Okay, I understand the mechanics of the loop, but as an investor looking for a perpetual hold, I have to be incredibly skeptical here.
Always a good idea.
When I hear about this DBS playbook, my instinct is to compare it to like a physical replumbing of a house, right?
Okay, I like this analogy.
You walk into a house you just bought, and the water pressure in the R&D shower is terrible. So you tear out the drywall, you find the corroded leaking pipes in the basement, that's the G&A bloat, you cut them out, and you route all that high-pressure water directly into the R&D shower.
Sounds great on paper.
It makes for a phenomenal slide deck presentation. But honestly, if you listen to any Fortune 500 earnings call, every single CEO claims they are leaning out operations. Lean manufacturing and synergies just feel like hollow corporate buzzwords used to justify mass layoffs to Wall Street.
That happens a lot, yes.
So how do we know, looking at the actual data, that Danaher isn't just cutting costs to the absolute bone at the expense of their own future? How do we know this isn't just a starvation diet disguised as a corporate fitness plan?
That is the single most important question you can ask when evaluating a company rolling up smaller businesses. Because if you want to know if a management team is secretly starving a business to artificially inflate short-term margins, you actually don't look at the margins.
You don't.
No, the margins will look great while they're starving it. Instead, you look at the top line. You look at the revenue.
Oh, okay.
If you cut too much fat, you inevitably start cutting bone. The customer service hold times get too long. The next generation product is delayed because R&D is underfunded. The best salespeople leave because their quotas are impossible.
And when that happens, the customers notice, and your core organic revenue growth will flatline or go negative.
Exactly. The product degrades, the customer realizes it, and they stop buying. And yet, what do the 10 years of sources actually show for Danaher?
What do they show?
Alongside that persistent, aggressive gross margin expansion, Danaher consistently delivers mid-single-digit core organic revenue growth. Their lifetime value to customer acquisition cost ratio, the LTV to CAC dynamics, remains incredibly strong across their portfolios.
So the customers stick around and keep buying.
The fact that persistent revenue growth continues uninterrupted proves that the R&D reinvestment is real and is yielding high returns. They aren't starving the engine, they are turbocharging it.
Give me an example.
Look at the data from the first quarter of 2021. Core margin expansion was 900 basis points, and operating profit margin was up 1,300 basis points year over year.
1,300 basis points, that's insane.
You simply do not achieve 1,300 basis points of operating leverage if the underlying business, the product quality, or the customer relationship is deteriorating.
Right, so the incremental margins, which is the profit they make on the very next dollar of sales they bring in, are massive because the fixed cost base is so tightly controlled by DBS.
Exactly.
They bring in a new dollar of revenue, and a disproportionate amount of it falls straight to the bottom line as cash. That is the definition of high-quality unit economics.
It really is.
Okay, so the engine room is pristine. Generating that kind of cash, maintaining mid-20s EBITDA margins, and growing the top line organically is an incredible feat. But here is the brutal reality of capitalism.
Let's hear it.
In a free market, outsized profits act like a giant glowing beacon. They attract aggressive, well-funded competitors who want to steal your customers by undercutting your prices.
Yep, margin is a magnet.
High margins are fantastic, but maintaining them for decades requires a profound structural advantage that prevents a rival from just reverse engineering your mass spectrometer and offering it for 20% less.
This is exactly why great unit economics alone are not enough for perpetual ownership. And that leads us directly into the second pillar of our framework. We need to analyze Danaher's competitive moat.
Let's examine the revenue mix, because this is where the financial story transitions into a behavioral story about their customers. Danaher boasts a massive global portfolio where roughly 57% of their total sales are recurring.
That's a huge baseline.
And by the time you look at the later data in the 2020s, specifically in the life sciences segment, that number climbs to over 60%.
The terminology management uses here is highly intentional. In their 2023 Investor Day, they explicitly describe their business model as razor blade.
The classic Gillette model.
Exactly. And this specific model is arguably the holy grail for a perpetual hold thesis. Danaher has a massive, globally distributed installed base of incredibly complex analytical instruments.
These physical instruments, the hardware sitting in the laboratories, represent the razor.
Yes. Once that expensive razor is installed on a lab bench or integrated into a hospital network, it drives a continuous, highly predictable daily stream of consumable and service sales. Those are the razor blades.
And the most critical word I found buried in the sources is captive. These consumables are captive.
What does that mean in this context?
It means you cannot buy a Danaher mass spectrometer or like a tissue sectioning machine and then go to a cheap discount supplier in another country for the chemicals, the reagents, or the testing cartridges that run inside it.
You're locked in.
They are closed systems. The recurring revenues are permanently attached to proprietary mission-critical equipment used by highly trained professional end users.
And to compound that advantage, we have to look at their distribution model. The data shows that roughly 2/3 of Danaher's sales are direct.
Meaning no middlemen.
Right. They are actively bypassing third-party distributors for the vast majority of their revenue. They have their own armies of specialized sales engineers and service technicians.
So mechanically, this allows them to capture the maximum amount of margin because they aren't paying a cut to a distributor.
But more importantly, from a moat perspective, it creates deep customer intimacy. When the machine breaks or when a new assay is needed, the lab director is calling a Danaher employee. Danaher owns the relationship.
Okay, that structural setup sounds flawless on paper. But as a consumer, when I hear the phrase razor and razor blade, and I hear about closed systems and proprietary consumables, my blood pressure immediately spikes.
Why is that?
I instantly think of the classic printer and ink business model. We all absolutely despise being locked into buying proprietary printer ink.
Oh, yeah. It's the worst.
You buy a printer for $50 and then you're trapped paying $80 for a tiny plastic cartridge of cyan ink just to print a shipping label. It feels like a total shakedown.
It does.
So why on earth would highly educated scientists, sophisticated lab directors, and ruthless hospital administrators tolerate being locked into Danaher's closed systems? Why don't they rebel, pool their purchasing power, and demand open source platforms where they can buy generic reagents?
The printer ink analogy is the perfect devil's advocate position. And on the surface, it feels identical. But it fundamentally misses the underlying economic reality of Danaher's specific markets.
Which is what?
The consistent, overwhelming generation of consumer surplus.
Consumer surplus. Okay, break down how that applies here.
Consumer surplus is an economic concept defined as the difference between what a customer actually pays for a product and the total holistic value they receive from it. With a home printer, the value you derive from printing a chicken recipe is incredibly low. It's not life-changing. So the high recurring cost of the proprietary ink feels disproportionate and extortionate. The consumer surplus is near zero or negative.
Right, I'm just printing a recipe.
But let's look at Danaher's end markets. As the 2021 annual report eloquently puts it, they are serving the basic building blocks of life.
That's a pretty big claim.
We are talking about clinical diagnostics in a bustling hospital emergency room. We were talking about biopharmaceutical manufacturing facilities where a company is trying to produce a complex, life-saving biologic drug for cancer therapy.
Okay, the stakes are infinitely higher.
They are literally life or death, but they are also massively existentially financial. Let's walk through a concrete example to illustrate the switching costs.
Walk me through it.
Let's say a major global biopharma company is manufacturing a new biologic drug. They've spent years and hundreds of millions of dollars validating their entire manufacturing workflow using a specific interconnected set of Pol filtration systems and sativa bioreactors.
Both of which are owned by Danaher.
Right. That exact physical process, down to the microscopic properties of the filter paper, is rigorously documented and approved by the FDA.
Okay.
Now, imagine a startup competitor comes along and offers the purchasing manager a generic filter that is 30% cheaper. The biopharma company is absolutely never going to switch.
Because if they change even one component, they have to revalidate the entire process with the FDA to prove the drug hasn't been altered.
The cost of that regulatory disruption, the millions of dollars spent on revalidation, or the catastrophic horror of a batch contamination because the generic filter failed, far outweighs any minor incremental cost savings on the consumable.
That makes total sense.
A single batch of a biologic drug can be worth tens of millions of dollars. You do not risk a $10 million batch to save $500 on a generic filter. The reliability, the proven automation, the exact proprietary readouts from a Beckman-Coulter diagnostic machine provide so much immense value in labor savings, workflow speed, and regulatory compliance that the customer happily accepts the lock-in. The consumer surplus is massive.
The value of the accurate test result, or the pure biologic yield, is so high that the cost of the ink is basically a rounding error on their P&L.
Exactly.
And this ties into a brilliant point the CEO made in the 2017 guidance call. He pointed out that this captive consumable model makes Danaher's revenue an OpEx-driven necessity.
Operating expenses.
Right. It fundamentally insulates the business from CapEx spending cycles. If a hospital network has a bad year and slashes its capital expenditure budget, they might delay buying a brand new multi-million-dollar MRI machine.
Sure.
But they still have to buy the daily diagnostic test kits, the reagents, and the wash solutions from Cepheid or a radiometer just to keep the emergency room legally and functionally operating today.
That OpEx nature creates a phenomenal baseline of recurring revenue predictability. And this moat is further reinforced by massive scale economics.
Let's talk about that scale.
Over the last decade, Danaher has systematically brought incredible legacy brands under one roof. Beckman-Coulter, Cepheid, Leica, Pol, Sativa, IDT. By doing this, they possess a differentiated, comprehensive asset base that smaller competitors simply cannot match.
It's a one-stop shop.
Exactly. If you are a massive hospital network or a global pharma giant, you don't want to deal with 50 different vendors. You want to deal with one vendor who can supply the entire workflow globally with direct 24/7 service and support.
Right, because downtime is unacceptable.
A brilliant startup with one highly innovative piece of hardware cannot easily replicate Danaher's global distribution footprint, their regulatory expertise, or their massive network of field service engineers. The network effects and scale advantages are deeply structurally entrenched.
So we've established the first two pillars. We have elite unit economics driven by the relentless mechanical efficiency of the Danaher business system, and we have a deeply entrenched competitive moat built on captive recurring ratios, FDA regulatory barriers, and overwhelming consumer surplus.
The engine and the moat.
But here is the vulnerability in any perpetual hold thesis. An incredible moat throwing off billions in free cash flow can be systematically destroyed by a poor, ego-driven management team.
Well, we see it all the time.
Right. If they take all that beautiful free cash flow and just light it on fire by making terrible, overpriced acquisitions just to build an empire, the unit economics collapse and the thesis dies.
It's a very real risk.
Which means we must examine who is actually pulling the levers. Let's move to the third pillar, management quality and the capital allocation track record.
This specific pillar is where we separate the good businesses from the truly great ones. Management teams have many metrics they can focus on, but Danaher's stated primary metric for measuring the efficiency of their capital deployment is return on invested capital, or ROIC.
Not just revenue growth.
No. They are not obsessed with just growing top-line revenue for the sake of ego or moving up the Fortune 500 list. They are obsessively focused on how much actual cash those investments yield relative to the capital required.
And what do the numbers look like?
Well, the historical sources show that by 2022, the company's overall ROIC sat at a phenomenal 20%.
Generating a 20% ROIC when you're operating at a $20+ billion scale is incredibly rare. It's one thing for a small software startup to hit those numbers, but for an industrial scale life sciences behemoth, it's wild.
It is wild.
So how exactly are they deploying this capital to achieve those returns?
Their capital allocation playbook relies heavily on mergers and acquisitions.
Yeah.
But it is a very specific, disciplined M&A strategy. They don't just buy random profitable companies.
What are they looking for?
They look for what they call an anchor asset in an adjacent, highly attractive science or technology market that has durable growth characteristics. They acquire that anchor asset, and then they immediately unleash the Danaher business system on it to improve the fundamental margin structure.
And then what?
Once the anchor is stabilized and highly profitable, they supplement it with smaller, strategic bolt-on acquisitions to expand its reach.
The track record of execution on this specific playbook, stretching back over a decade, is meticulously documented in these sources. Let's look at the historical examples to see if the reality matches the theory.
Let's do it.
The 2016 Investor Day transcript highlights businesses like Hatch, Videojet, and Radiometer. These were acquired many years prior at mid-single-digit returns. They were not screaming successes when purchased.
But they were systematically improved using DBS. And a decade later, Danaher had transformed them into machines generating high teens ROIC.
And we can look at a more recent, massive example that truly proves the model at scale. Pall Corporation.
Paul is the perfect case study.
When Danaher acquired Pall, it was essentially a stagnant asset. It was operating with low single-digit to teen margins, bloated middle management, and inefficient cost structures.
Just kind of limping along.
Exactly. But by deploying DBS, by physically going in and leaning out the COGS, restructuring the G&A, and reinvesting the savings into a better sales force within just a few years, they had improved Pall to approximately 25% operating margins.
And they ran the exact same playbook with Nobel, taking it from a low single-digit operating margin to north of 20%.
That's incredible execution.
It proves they don't just buy revenue to look bigger. They purposefully buy undermanaged, under-optimized assets with low initial returns and use their core competency of operational excellence to permanently expand the margin profile.
What's absolutely vital for an investor seeking perpetual ownership to understand is the why. Why does management do this so systematically instead of just taking the easy road?
Incentives drive behavior.
Exactly. We looked incredibly closely at the 2026 proxy statement, which outlines how these executives actually get paid. Executive compensation at Danaher is highly, almost aggressively aligned with long-term shareholders.
It's heavily biased toward long-term equity.
Right, rather than short-term cash bonuses.
The incentive structures are fascinating. They have mandatory multi-year vesting for standard stock options. But even more impressively, for their performance stock units, or PSUs, which make up a massive chunk of executive compage, They require a rigorous 3-year performance period where specific financial metrics must be met.
Okay, a 3-year hurdle.
And then even if they hit those metrics, there is an additional mandatory 2-year holding period before the executive can sell the stock.
So wait, that is a full 5-year horizon before an executive can fully realize the financial value of that award?
Exactly. They literally cannot get rich on a 1-year sugar high.
Furthermore, they have strict no-fault clawback policies that are triggered even in the absence of intentional wrongdoing if financial results have to be restated. And the sheer ownership requirements are massive. The CEO is mandated to hold 6 times their base salary in Danaher stock. Executive vice presidents must hold 3 times.
They are heavily incentivized to eat their own cooking over a half-decade time frame.
But reading through this M&A playbook, I have to bring up a suspicion that I think a lot of critical investors would have.
Okay, let's hear it.
This entire strategy, buying underperforming assets, ruthlessly cutting the G&A costs, rolling up smaller competitors, expanding margins, it sounds suspiciously like a private equity firm disguised as a publicly traded healthcare company.
Oh, that's a very common critique.
Are they just financially engineering their way to growth through endless acquisitions? I mean, if the broader M&A market freezes or if interest rates spike and the music stops, does this whole roll-up strategy collapse under its own weight?
It is a common critique from analysts who only look at the surface level. But it fundamentally misunderstands the mechanical differences in how Danaher creates value compared to private equity. Let's clarify the crucial difference.
Okay, lay it out.
A traditional private equity roll-up relies almost entirely on heavy debt load leverage to juice the equity returns. A PE firm might buy a company using 70% debt and only 30% equity.
Right.
They aggressively cut costs to service that massive debt load, and their ultimate goal is to sell the company to someone else in 5 years at a higher multiple.
It's the classic PE flip. They use financial leverage to amplify the return.
Precisely. Danaher does not do that.
Mm-hmm.
Because of that greater than 100% free cash flow conversion we spent so much time analyzing earlier, Danaher organically generates so much immense cash that they primarily funds these multi-billion-dollar acquisitions with their own cash flow or with highly manageable levels of investment-grade debt that they pay down rapidly.
So they aren't dangerously loading up the corporate balance sheet with massive leverage to fund the M&A engine.
That lack of leverage is key. Historically, they have returned only a modest dividend to shareholders, and they actively avoid share buybacks unless there is a severe, widespread market dislocation where the stock is irrationally cheap. They purposefully hoard their cash to buy businesses outright.
Okay, that makes sense.
But more importantly, PE often relies on multiple expansion to exit, meaning they buy a company at 10 times earnings, and their whole thesis relies on hoping the market is hot in 5 years so they can sell it at 15 times earnings.
Right, hoping for a bigger fool.
Danaher generates its returns through permanent operational margin expansion. Moving Paul Corporation from teen margins to 25% margins isn't financial engineering. It is physical operational engineering on the factory floor and in the back office.
They are structurally changing the underlying profitability of the business asset.
Exactly. And because of that 5-year horizon on executive compensation, management is physically prevented from pursuing short-term accounting tricks. They are forced to underwrite acquisitions that actually generate real, sustainable cash over a long time horizon.
That operational reality perfectly aligns with the requirement for perpetual ownership. It is operational engineering, deeply grounded in the Danaher business system, safely funded by organic cash flow, and tightly aligned by a 5-year compensation horizon.
It looks brilliant.
On paper, yes. When the macroeconomic environment is good, this management team looks like a squad of operational savants.
In a bull market, they look completely unstoppable.
And this is a massive, incredibly important but. A true perpetual hold thesis must be severely stress-tested. We cannot just read the glossy 10Ks from the good years, nod our heads, and cheer.
No, we have to look at what actually happens when the massive secular tailwinds suddenly turn into gale force headwinds.
Which brings us to the fourth pillar. Stress testing the thesis, evaluating the headwinds, and practicing rigorous intellectual honesty. Let's start by framing the tailwinds because they are substantial and they provide the baseline for why Danaher is in this specific industry.
They are deliberately riding massive long-term secular trends.
Right. They are benefiting from the transition from traditional small molecule chemical drugs to incredibly complex, large molecule biologics and genomics.
A huge shift in medicine.
They're capitalizing on the desperate need for lab automation driven by a structural global shortage of skilled laboratory workers. They are riding the improving standards of healthcare in high-growth, emerging markets like China, where an expanding middle class is demanding better, faster diagnostics.
Very durable trends.
And looking forward into our 2026 sources, they are explicitly betting heavy capital on integrating AI to accelerate pharmaceutical development and dramatically lower the massive costs of early-stage drug discovery.
Those are durable, decade-long trends. But we promised intellectual honesty. We have to look at the dark side of the data.
Let's go there.
In the third quarter of 2023, Danaher faced a severe, undeniable crisis. The operating margin plummeted by a shocking 540 basis points.
540 basis points.
It dropped all the way down to 20.9%. Core organic revenue in their vital biotechnology and diagnostic segments suffered a real, tangible blow. Management, of course, got on the Q3 2023 earnings call and attributed this drop to lower volume in biotechnology and complex costs related to spinning off their environmental business, Veralto.
And this is exactly where we, as rigorous analysts, must refuse to just accept management's polite, positive spin. We have to look at the brutal mathematical reality of operating leverage.
We do.
Earlier in this analysis, we praised the operating leverage loop. We talked about how keeping fixed costs incredibly low while aggressively growing revenue creates massive, disproportionate upside for the bottom line.
We saw the magic of that in Q1 2021 with the 1,300 basis point margin expansion.
But operating leverage is a strict double-edged sword. The physics work in both directions.
Right. When sales volumes drop, that exact same fixed cost structure of the factories, the highly paid direct sales force, the expensive R&D labs, suddenly acts like a massive anchor, dragging margins down violently.
The 2023 downturn exposed a very real vulnerability in the model. We have to look at the context.
What was happening globally?
Well, during the height of the COVID-19 pandemic in 2020 and 2021, Danaher heavily, aggressively expanded production capacity at key businesses like Cepheid, Sativa, and Pall to meet unprecedented emergency global demand for diagnostic testing and massive vaccine manufacturing.
They stepped up when the world needed them.
They built new factories, they hired thousands of people, they scaled up their footprint globally to literally help save the world.
And to be fair, they made an absolute fortune doing it. The cash flow was astronomical.
They did. But when the acute phase of the pandemic ended, that massive emergency demand evaporated almost overnight. But it was compounded by a secondary effect.
The hoarding.
Exactly. During the pandemic, their biopharma customers were terrified of global supply chain disruptions. So those customers spent 2 years aggressively hoarding inventory, buying up every Pall filter and Sativa bioreactor bag they could get their hands on, and stuffing them into warehouses.
Stockpiling everything.
So in 2023, Danaher faced a brutal post-COVID hangover. Customers completely stopped buying new consumables, not because they stopped producing drugs, but because they were working through the massive hoarded stockpiles in their own warehouses.
In the industry, this is known as a severe destocking cycle.
So Danaher was left holding the bag. They had this newly expanded, highly expensive fixed capacity sitting there, but the massive consumable orders just stopped coming in.
And mathematically, that destroys unit economics temporarily. High fixed costs divided by significantly lower volume equals plummeting margins. 540 basis points of profitability vanish.
Wait a second. I have to challenge this because this feels like a contradiction.
Okay, challenge it.
We spent 20 minutes earlier meticulously establishing that the recurring revenue is sticky and captive. We talked about consumer surplus, FDA regulations, and massive switching costs. We built this impenetrable fortress.
We did.
If this revenue is so sticky, why did the bottom fall out so violently in 2023? Sticky revenue isn't supposed to just unglue itself simply because a pandemic ends. Does this 2023 margin crisis fundamentally break the moat thesis we just built?
It is a critical challenge, and it's the exact question that caused panic among short-term investors during that quarter. But we have to evaluate the specific nature of the damage. Did the moat break? No. What we actually saw was that the utilization of the moat normalized.
Utilization. What is the distinction there?
It is the difference between churn and volume, meaning the customers didn't leave Danaher for a competitor.
Correct.
A major hospital network didn't rip out a Beckman Coulter diagnostic machine and replace it with a cheaper rivals machine.
Right.
A biopharma manufacturing plant didn't switch from Sativa bioreactors to a cheaper generic knockoff.
Mm-hmm.
The massive FDA switching costs held perfectly. The moat was entirely intact. The customer churn rate didn't spike.
They just stopped running as many emergency tests, and they burned through their hoarded inventory.
Precisely. They just didn't need to physically buy as many cartridges from Danaher that specific quarter. The overall volume of testing dropped, but Danaher's market share did not drop.
Oh, okay.
For a perpetual ownership investor looking out over decades, this distinction between utilization drop and market share loss is everything. The core investment thesis holds because the massive secular drivers, the rapidly aging global population, the complex transition to large molecule biologic drugs, those trends are deeply durable over a 10-year or 20-year horizon.
The 1 to 3 year horizon simply suffered a severe disruption because of a once-in-a-century global pandemic and the resulting supply chain whiplash.
So the fundamental business architecture is fully intact. The engine is still there.
It is intact, yes. However, maintaining intellectual honesty requires us to explicitly state a hard, unavoidable truth. An investor must accept that Danaher's earnings are inherently more cyclical than management likes to admit in their glossy presentations.
They definitely don't highlight the cyclicality.
The razor blade model is incredibly resilient, but it is not magically immune to massive inventory cycles or macro-level biotechnology funding pullbacks. If the broader biotech sector faces a capital crunch and stops getting venture capital funding, those small startups stop running as many experiments, and inevitably, Danaher sells fewer consumables.
Right. You cannot own this stock thinking it will grow in a perfectly smooth straight line every single quarter.
That is a vital concession. The moat survives the stress test because the customers are still captive, but the top-line growth is not perfectly linear. We have to accept periods of painful cyclicality.
Agreed.
So, looking past the 2023 hangover and acknowledging the reality of the business cycle, we have to look to the future. Which brings us to our final analytical pillar, the reinvestment runway and the law of large numbers.
This is the big one.
Can this specific management team continue to deploy capital effectively at their current, frankly, massive scale?
This is the ultimate defining question for the next decade of Danaher's existence. As of the data in our 2025 and 2026 sources, Danaher is an absolute behemoth of a corporation. They are generating nearly $25 billion in annual sales.
$25 billion.
They're throwing off roughly $6.4 billion in pure operating cash flow. Management boldly claims they have a value creation margin of 35 to 40%, and they are publicly stating they still expect double-digit earnings per share growth fueled by their continuous M&A strategy.
But the mathematical reality gets incredibly difficult at this massive scale, doesn't it?
It does. In a deeply honest moment during a 2024 presentation, management themselves admitted a stark reality regarding their M&A impact. They used a recent major multi-billion-dollar acquisition, a company called Abcam, as the example.
What did they say?
They admitted that buying a massive, highly successful company the size of Abcam now only adds about 2% to Danaher's overall corporate growth rate.
And that reality is the crux of the issue. As analysts, we have to assess the actual probability that their current growth initiatives will sustainably generate returns above their cost of capital moving forward.
Now, theoretically, the reinvestment runway is still massive because the global life sciences and diagnostics markets are highly fragmented. There are hundreds of incredibly innovative, niche science companies out there waiting to be acquired.
For plenty of targets.
But Danaher's sheer massive size is now a structural headwind to their percentage growth.
It's the inescapable law of large numbers. Let me frame it this way. Think of Danaher like a massive blue whale in the ocean.
A blue whale, okay.
A blue whale needs to eat exponentially more krill just to survive the day than a tiny minnow does. If spending billions of dollars to acquire a major established player like Abcam only buys them a measly 2% growth bump for the entire year, aren't we mathematically guaranteeing that their historical days of generating 20% ROIC are permanently behind them?
It's a very fair point.
I mean, to move the needle now on a $25 billion revenue base, they either have to make increasingly larger, riskier acquisitions, which inherently carry way higher integration risks and usually lower initial returns, or they have to rely heavily on organic internal innovation, like their 2026 bets on AI drug discovery.
Isn't the golden age of easy DBS margin expansion just over?
It is a sober, rigorously analytical conclusion that we must draw from the data. Yes, the percentage returns on invested capital are highly likely to slowly, inevitably compress over the next decade as the denominator, the total capital base of the company balloons to this massive size.
That math just gets too hard.
It is mathematically nearly impossible to compound $25 billion at the exact same percentage rate that you compounded $5 billion a decade ago.
So if the percentage returns are actively compressing, does the perpetual hold thesis fail?
No, it does not. And here's the crucial philosophical distinction. For a perpetual ownership investor, you don't spend percentages at the grocery store. You spend absolute dollars.
That's a great point. While the percentage ROIC may slowly compress from 20% down to, say, 15 or 16% over the next decade due to the law of large numbers, the absolute dollars of free cash flow being generated will remain utterly immense.
$6.4 billion of operating cash flow is a massive amount of krill.
Exactly. The probability of them continuing to generate returns that comfortably exceed their cost of capital remains exceptionally high.
Why is that?
Because the Danaher business system integration playbook isn't dependent on a few genius executives. It is deeply structurally institutionalized. They know exactly how to extract operational value from acquisitions, even large, complex ones.
Right.
Furthermore, their explicit shift toward integrating artificial intelligence into the pharma development flywheel, as heavily noted in the 2026 earnings call, shows they're intelligently pivoting to where the puck is going. By embedding AI into their analytical instruments, they are entrenching themselves even deeper into the high-value, early-stage drug discovery process.
So the thesis doesn't break, it just shifts slightly in its character.
The era of explosive hypergrowth, the era of taking tiny, inefficient companies and creating massive percentage gains overnight, is gracefully giving way to an era of mature, unstoppable, massive-scale compounding.
They're becoming a utility.
They have essentially become a utility-like provider for the global life sciences industry. As an investor, you must accept that you will likely get lower percentage growth, but in exchange, you are getting unparalleled durability, incredibly high barriers to entry, and massive absolute cash generation.
So we have put Danaher under the microscope. We've meticulously examined the unit economics in the DBS engine. We've tested the captive razor blade moat. We've evaluated management's M&A playbook. And we've stared down the brutal realities of the 2023 destocking crisis and the law of large number.
We've covered a lot of ground.
It is time for the verdict. Based on a rigorous analysis of the underlying business quality, completely ignoring the current stock price, does Danaher merit a perpetual long position in a generational portfolio?
Based on the synthesis of the last 10 years of operational and financial data, the definitive answer is yes.
Yes, but with clear eyes regarding the reality of the business.
Yes, with absolutely clear eyes. The unit economics are elite, underpinned by the tangible mechanical reality of the Danaher business system and that extraordinary greater than 100% free cash flow conversion.
A moat is there.
The competitive moat is deeply entrenched. The FDA regulatory switching costs and the massive consumer surplus of the captive razor blade model ensure that customers rarely, if ever, leave.
And the management team's compensation structure, specifically those mandated 5-year horizons on performance stock units and the massive insider ownership requirements, perfectly aligns their capital allocation decisions with your goal of long-term value creation.
Exactly. They buy with cash, they permanently improve operations, and they fundamentally do not play private equity debt games.
The only concession you, the investor, must explicitly make is accepting the math. You must accept slightly lower percentage growth moving forward due to their massive scale, and you must accept that the earnings will experience cyclical periods of inventory destocking and macro funding crunches, just as we saw in 2023.
That's the reality of the business cycle.
But over a 10 to 20-year horizon, the immense structural tailwinds of complex biologics and global healthcare demand will easily overpower those short-term cycles. It is a compounding machine worthy of the vault.
I couldn't agree more.
So we've broken it all down, we've laid out the mechanics. But as we wrap up this deep dive, I want to leave you, the listener, with one final provocative thought to mull over.
Let's hear it.
It's something that isn't explicitly modeled in any spreadsheet, but it is perhaps the most important question of all when evaluating this company. Danaher's entire operational playbook, from the roots of their lean manufacturing to exactly how they ruthlessly cut G&A, to their highly specific M&A strategy of buying anchor assets and bolting on smaller companies, it has been entirely public knowledge for decades.
It's not a secret at all.
They literally publish the core tenets of DBS in their public slide decks. It's taught as extensive case studies in Ivy League business schools. Everyone in the corporate world knows what the Danaher business system is.
Everyone knows the playbook.
So if the blueprint is sitting right out in the open for any rival CEO to read, Why hasn't a single competitor successfully cloned it? What is the invisible, uncopyable cultural moat that allows Danaher to rigorously execute what every other company can only theorize about in board meetings? Think about that the next time a CEO gets on an earnings call and tells you they're going lean.